Subordination or loss protection in private credit deals can be a real strength in making the risk-reward dynamics of a deal favourable towards the investor. When we're doing asset-backed lending where our investors are taking exposure to a private credit investment that is funding a portfolio of loans being made by a business, be this for a non-bank lending business or some form of private lender, we will structure and agree the terms of the deal with a level of subordination or loss protection that we view is sufficient to the risk and returns that we're seeking when we're giving consideration to the exposures that we're taking on via the underlying portfolio of loans. What I mean by this is that the loss protection percentage represents the required level of collateral that must sit underneath our exposure in order to absorb the first losses from the pool of loans prior to our exposure essentially being affected. If I use 20% as an example, if a private credit investment has 20% loss protection, 20% of the portfolio of loans that we are funding would need to be making losses before a dollar of our investor capital is essentially at risk. This subordination or loss protection buffer requires the business to hold equity capital or cash essentially to that prescribed percentage of the total exposure of our facility. It can be achieved by having a more junior note that incurs those losses first, or it can be a combination of both equity as well as a junior note. If you now think about this in the context of a business that is extending loans to small businesses or perhaps to private households, in order for the loan portfolio to see total losses climbing towards that 20% level, you are likely talking about a very big series of client events or a significant economic change to their borrower base to have that amount of loans actually defaulting. Probably the greatest risk reward that we tend to see in this regard tends to be the senior tranches that we offer in privately negotiated asset-backed lending. So in summary, asset-backed lending deals that are structured with subordination or loss protection can really benefit investors as they are well protected for any potential losses to the underlying pool of loans. I hope this has just helped clarify subordination or loss protection for you. Thanks.